Hi guys, right. So this is chapter 13, performance measurement and control. Chapter 13. When we start looking at this chapter, you'll be familiar with a number of things you'll see in there. This question, I mean, this says performance measurement, so we're talking about performance. Really, we're talking about, of course, we'll be given some data, and of course, generally, management accounting and financial accounting will always have financial performance indicators in there to look at your classic areas of profitability, nothing new here, um, liquidity and risk, right? So these are the traditional events we have always tried to measure, if you like, for a long time, and to see how well an organization, if you like, basically these are the benchmarks for performance and really suggest methods for improving these measures, right? But really, the argument here is that we are looking at data interpreting these, and trying to improve these measures. That's really what we're looking at. Really, looking at, well, of course, for risk, we've talked about that. Liquidity, we've talked about that. Profitability, we've talked about that. And then also what was interesting here is we're going to be trying to understand scenarios to be able to look at non-financial performance indicators. So really it's looking for relationships between events to sort of see if we can actually find some relationships and then sort of be able to make a case. So for example, staff absenteeism or number of accidents. And so we're really looking at other sort of benchmarks that aren't, if you like, on the statement of financial position. So yeah, and discussing this whole idea of some of the shortcomings, if you like, of these ratios, because of course they look at them over, if you like, a short period, a set period, typically a year. And when you're rewarded based on this type of method, you will tend to see some degree of financial manipulation. And so the discussion or the argument is maybe how do you have a more long-term approach to sort of being able to see, to get the best out of your employees or your managers. And then we look at some of the behavioral aspects of performance management. And then we look at some of the sort of general sort of theories behind how we address non-financial performance indicators. And your classic balanced scorecard we will look at, and we'll come to that. And that really says, really the argument here is very much about if you like, if you can manage to deal with some things that aren't typically on the statement of financial position, then you will see important improvements in the financial performance. So if you can improve customers, how customers think, what customers, if you can find out what customers actually think, if you can look at how employees are doing, and you can improve performance there. If you can look at your internal processes, if you like, and improve those things. Yeah, and that sort of thing we'll see in the balanced scorecard. We'll also see another method called the Fitzgerald and Moon, and both of these are required. You need to be definitely 100% comfortable with the balanced scorecard and Fitzgerald and Moon, if you like. Okay, great stuff. So let's jump into it. So I'll start off, of course, first of all, with ratio analysis. Again, what we're looking at, like I said, is ratio analysis, NFPIs, non-financial performance indicators, and we'll be discussing some behavioral considerations. Like I said here, as with variances, ratios indicate areas for further investigation rather than giving a definitive answer. So typically we're kind of looking at trends when we look at these things, aren't we? And then we're able to make decisions. I've already talked about the key ones being profitability, liquidity, and risk. Okay, I've written this as a working page, fundamentally just to kind of write out those classic ratios again. I'm sure you have to remember them. Typically, when we look at profitability, yes, we typically are looking to see, if you like, how much profit, if you like, or what have we kept fundamentally for ourselves after what we have sold. So typically, you could argue you have revenue. I'm just going to create a simple scenario here of year 1 and year 2. If you like 100, and you have cost of sales, and you have gross profit, and you have operational expenses, and you have net profit. So just looking at profitability, here's the thing. If you have £100 coming in terms of revenue, and you have cost of sales of 60, and you have gross profit of 40, this is fundamentally saying, right, for every £100 that you receive, you're keeping 40 after the actual cost of sales. So typically, I remember asking students, would you sell sneakers, or would you sell I don't know, something, what was it? I think I used to use something simple like counters. Nothing exciting, counters. But imagine, look at this, right? So you could sell, each of these counters are £1, but you could sell 100 of them, a bag of 100. They'll cost you £20, and you keep 80 for yourself. And you'll still get students getting things like, oh, listen, I'm excited. I love trainers. I love sneakers. I'll do this. But hey, what's the point of working so hard, get £100 coming in? Well, and technically only keeping 40 for yourself because you have to give the supplier 60 of it. So the gross profit margin, of course, helps us look at that and assess that. And ultimately, we want to be picking or picking the product, or improving or increasing that gross profit margin. So in this case, the gross profit margin is 40%. And in this case, the gross profit margin, of course, is 80%. And then, of course, we have operational expenses. Maybe this is 10, and maybe this is, I'm just going to exaggerate this now. Maybe this is 70. And now you have a net profit margin of 30, you have a gross profit and net profit margin of 10. So in exactly the same way, we can sort of argue that, listen, how much we received 100, how much you keep for yourself. So you kept 30 for yourself, and that's 30%. Here you kept 10 for yourself, and that is 10%. And so the point being, again, if you like that, the point being that we can now sort of assess this. And when we're typically assessing your net profit margin, we're really looking fundamentally at the operational expenses, right? We're really sort of saying what's going on over here with these. And this is, like your day-to-day running of when I say day-to-day running of the business, admin costs, transport, light, heat, whatever it is. So you can see that despite a good GP margin start off, operating expenses just have not been able to put under control. Marketing, something's going on. Now, what you want to 100% do is to always look at the operational expenses as a proportion of sales, you see, because really this is the key point. This is how you know what's going on. So 10 out of 100, and you can work out a ratio. There's nothing wrong with that. 70 over 100. Here it's 10%, and here it's 70%. So you can clearly see here that of the operational sales, operational costs are eating 70% of those sales, as opposed to here just 10%. So that you can please calculate that when you now try and explain this movement from here to here, if you like. Right. And the last ratio on profitability that we'll look at, if you like, is the gross profit. Well, there's two more, forgive me. The return on capital employed. Using this same, whoops, sorry. I don't know what happened there. No, don't want to do that. Erase all ink. Oh, it's recording what I'm saying. Right. Oh, very interesting. I've never noticed that before. How do I get rid of that? Right. Let me discard. Okay. Right. Let's go back here. Okay. Great. So let's just go back to We had A and we had B over here. We had 100, and then here we had 100. So, for example, and remember, this came out to a net profit of 10, and this came out to a net profit of 30. Now imagine, right, in that year you had the choice of investing £1,000 in either of these businesses, and at the end of the year you were going to get let's just say all the return. Let's just say you're the only investor. So this is the capital employed, if you like, C, right, and this is the return. So if you had invested £1,000 in this business, you would have gotten £10 at the end of it. So you'd walk home with 1,010, or you could have walked home with 1,030. So ultimately, the way we know what business to invest in, or what's most, if you like, in terms of profitability, in terms of what has been worth your money's investment, we would need to find out what the percentage of that, if you like, what the return, which is what the net profit is. Net profit is a return on the capital employed. So you have 10 divided by 1,000 here, which is of course 1%. And here you have 3%. Not very much, but the point is that here we have a higher return on capital employed as opposed to this example over here. Right. That's that. Now, and then the final the final thing I want to pick up on is this business of, So typically, if you remember, of course, in your statement of financial position, you would have used your assets to work and generate that turnover, right? The whole point is, and we'll come to that, but the good point is here we have assets when using those assets to generate turnover, right? And we want to know how well and how hard working those assets are. In effect, what is the productivity of those assets if you're trying to see how well the assets are being used to generate turnover. And so, technically, we're really saying what is turnover divided by the, well, if you like, the net assets. But the net assets, don't forget that A minus L, which is your net assets, is equal to capital. So your net assets are actually equal to your capital employed, right? Same thing. So your productivity, in effect, well, your asset turnover, which is your productivity, well, call it by the right ratio, asset turnover is equal to turnover times capital employed, right? So in that scenario, I think I had turnover of 100 in the previous question, and my capital employed was 1,000, if you like. So this is 0.1, right? So if you can argue, you can say for every pound that's been invested, we are bringing out 10p of revenue. It's just a turnover. It's just a ratio, isn't it? And of course, you want products that are working very hard for you. Yes, and then so the final thing I want to pick up on, I think that is useful, that you should also write about, I think it's important to write about it, is to see this relationship. You see, typically, right, the aim of any business, of course, is to maximize the return on capital employed. And ultimately, the return on capital employed, if you like, is sort of saying, okay, you know what, let's look at the profitability. And what is profitability? Profitability is net profit divided by turnover, or, well, yeah, net profit divided by turnover, right? Because that's really what we're looking at. And if I also look at productivity, right? So yes, I want the business, I want what we're selling, I want us to be able to make a margin, a high margin of what we're selling, but I also want us to work very hard. So what we have here, if you like, are your turnover, like we discussed earlier on, divided by capital employed. So return on capital, how successful your return on capital will be based on the margin you're able to make on these products times how hard they are working. So net profit divided by turnover times turnover over capital employed will give you net profit, of course, over capital employed, which is why we return back to return on capital employed, right? I want to just highlight this to give you a nice practical example. Think of Waitrose when they sell vegetables. Typically, the profitability on vegetables might be very thin margins. They're just selling, if you like, day-to-day regular products. So low profitability, but they're working. Those assets are working very hard. All the assets in the business are working and churning a number. They're selling thousands of vegetable packets. So this is high, if you like. So that's one industry. You can have an industry, for example, like in manufacturing, where because it takes a long time to come out with the items, if you like, productivity is lower. But because it takes such a long time, they would have to increase the margins. So it'll, they would have quite high GP ratios because, if you like, it's taking them so long to build that asset, if you like. So in effect, what we have here is a way of assessing how well, or what we sort of understand the sort of relationships and ratios we should be getting with different businesses. Great. So yeah, so that's kind of a short summary, just on profitability, of course. And when we see the question of profitability, then we'll see questions on liquidity and things like that. Okay, see you in the next video.